I've just started the recording. So if everybody, just to be aware, if you register for one of our webinars, we do record it and we'll send it out to you afterwards in case you miss anything. We've got about 29 odd people registered for today. So it's a bit of a hot topic, and understandably so. So the one today is, why do my premiums go up and what can I do about it, with our very own Scott Denning running the session today. As with the last one, if you'd like to keep the questions to the end, that'd be fantastic. You've got the little chat ability at the bottom if you'd like to put a question in as we go, just so you don't forget it, or keep it to the end and we'll open it up for questions. So if everybody could just mute themselves so we don't get that cross sounds sometimes that come in while Scott's talking, and we'll open it up at the end. It's really over to you, Scott, to take us through the topic.
Great, thanks Nerida, and good morning everyone. As Nerida touched on, the subject today is why my premium's increasing and what can I do about it. I guess at the end of the day, my real aim out of today is to just help us all to understand a little bit about how insurance companies work and the things that they think about when they're trying to determine premiums for you and for us. We're substantial insurance premium payers ourselves. So that ultimately, if you understand how the other side works, then you can make some decisions around how strategically you might be able to make some decisions around how to, I guess, get the best result from dealing with our insurance partners. Excuse me, this is my first attempt at social media. I've just got to make sure I can get my slide to move on to the next one. Just by way of a quick introduction on myself, I've been doing insurance broking for around about 30 years. I did try an attempt at the dark side. I worked with an insurance company for a period of time. And I guess the position of their standard position is to say no, didn't sit naturally with me. So I came back to insurance broking because at the end of the day, insurance brokers are about solution delivering and trying to find solutions for our clients. And I joined Rivers about 6 years ago. And Rivers as a business, we're one of the leading Queensland-owned insurance brokerages. We've been around for 40 years, got about 40 people on the team and about 6,000 clients from everything from personal lines through to publicly listed companies. So in the way of our client experience, we do see a lot of things in respect of what's affecting everyone from mum and dad insurance through to bigger corporations and the different risk exposures that they've got. So we find that we're pretty well positioned to give some commentary on most of the things that are going on in the insurance world. The conversation I'm going to take you through today is, I'm just going to try and give you some insight into the actual costs that make up your premium, ultimately who the people are that are charging us our bills, what they're thinking, and then what we can do to try and minimise those premiums going forward. Just a reminder, I guess, there's lots of people running around marketing. We see lots of things like the little ferret running around talking about freedom of choice for insurance products and things. At the end of the day, those, I guess, multi-agent businesses in the mum and dad space and even the small business stuff, those providers of insurance solutions are agents of the insurer. They're actually working on behalf of the insurer. As insurance brokers, our job is to act on your behalf. We are your agent, and it's our role to complete your instructions and give you advice and proactive thoughts around how to manage your insurances. As a business, we deal with about 148 different forms of insurance companies. So we've got a large range of solutions for you. And ultimately, the responsibility of the insurance broker is to deal with the insurer on your behalf. We buy insurance on your behalf. We manage your claims and we keep you informed, I guess, on what's happening in the insurance market and what some of the solutions are that are available for you. So I guess to the bit that makes up the evil premium aspects that we've all got to pay, the obvious bit that we all see is the claims cost. And with the insurance companies, they're now very much looking into the future of what a premium that they write today could cost them. Settling a claim in 12 months' time, in this inflationary environment that we're in, and we've been seeing it probably through most of COVID, has been what can happen with building costs. Insure a building today that's worth $1 million, and it's possible that the cost of replacing that building in 12 months' time might have escalated by as much as 20%. So when they're factoring in their costs now, they're trying to look into the future and work out what a claim could cost them sometime in the future. And again, lots of our clients that we've been talking to, getting their hands on motor vehicles and things now, seeing the increase on costs of motor vehicles, those are going through the roof. And then liability claims. You might have a liability claim today that may not be settled for 7 years, 8 years longer. The ability for claims to escalate into the future can be substantial. So there's the physical cost of what it could cost today, but the insurers are looking into the future around what that could be sometime in the future. The other aspect that makes up the premium that we get over our dining room tables or at the office, reinsurance cost. That's the cost that the insurance companies have to stop them from having major losses that put them out of business. The interesting thing is a very large percentage of the reinsurance market is actually looked after by just 3 insurance companies. Munich Re, Swiss Re, Hanover Re. There's basically about 50 insurance companies that do reinsurance, but something like about 40% of the premium goes through those 3, and they really do control or direct a lot of the insurance companies around what they can and they cannot do. And the principle of insurance is about spreading the risk, but I guess when you've got 3 companies like that, you actually effectively end up aggregating risk. But that's a key part of the insurance costs that we do, that the insurance companies pay in advance when they're doing their reinsurance deals, which are predominantly due around end of June, and end of December is when they sort of buy their insurances. Administration and marketing costs, as again, most of us employers are experiencing, the cost of labour is going up. Insurance companies obviously employ a lot of people. And then just as an example, CGU, one of our larger providers, have just put on another 120 staff in the last month or so that are all new staff to the industry, or predominantly, just to try and manage their way through these recent catastrophe claims, predominantly out of February. So I guess they're managing those costs. And then ultimately, and we'll talk about the sort of businesses that insurance companies are, but then they're generating their profit margin. And I guess interestingly enough, for their average profit margin on their premium throughput's only between 2 and 4%, which when they're turning over the sort of premiums that they're doing, that turns into a big dollar number. But it actually doesn't take much of a negative trend to suddenly chew up a 2% or a 4% profitability. When, I guess, as we touched on earlier, you're seeing potentially 20% increase in building costs, etc. It doesn't take much to chew up a 2 to 4% profit margin. So hopefully that just sort of gives you a little bit of an understanding of where the cost comes from, but or the cost of our premium comes from. I will just talk a little bit more about the levers that they're all interested in respect to making this work in a minute. So I guess who are ultimately the players? We probably all see them as the Suncorps and the NRMAs and the CGUs and the QBEs. And then just an interesting thing, this perception of competition. Suncorp, as an example, actually has 8 brands that you and I, as sort of average purchasers of insurances, would see: AAMI, APS, Shannon's, Insure My Ride, Vero, Terry Shear, Caravan Insurance Limited, and Suncorp. So we sit there and go, oh my goodness, there's all this competition in the world for insurance, but all of those insurance companies that you and I see are actually all owned by Suncorp. Insurance Australia Group, who owns CGU, similar thing. Allianz, similar thing. So ultimately, that's all feeding back into the back end of a reasonably small number of businesses. who are predominantly publicly listed companies and reinsurance companies who all have this expectation or a requirement from their shareholders to generate an adequate return for those shareholders. But at the same time, that publicly listed beast that they are, there is an expectation for them to grow in a competitive market. So there's this, and this is, I guess, where we start trying to find the ways to get into having success for our clients, is trying to find ways to leverage off this desire or need for the insurance companies to grow whilst in a competitive market. And how we play that is a key part of our strategy in respect of finding ways that we can help our clients to get success. Failure, I guess, for publicly listed companies to achieve those goals of getting profitable growth ultimately results in those companies losing their capital. Shareholders will turn around and say, well, I can make some more money out of taking my money to a manufacturing industry or a medical industry. And ultimately, insurance companies that don't have enough capital because they can't pay their bills are not successful things. So that need to meet shareholders' needs is really important to them. But there's been some extenuating circumstances in the past around great interest rates, not so much in the last few years, etc., that's helped them to do business in a way that they didn't actually need to make money out of underwriting. But we'll touch a little bit more on that in a couple of minutes. So, yeah, how much have premiums increased? And I know I guess there's a few wiggly worms on that. But in short, the blue line's financial line, so that's professional indemnity, management liability, those sort of policies, and cyber insurance has been, to date, included in financial lines. And we all see stuff in the news about cyber insurance and what's happening. And you can see cyber insurance has gone absolutely through the roof. The black line, so the middle one at the end, is the property insurance. And that includes the property aspects of the housing market. And then the red one is public liability and all those sort of things. So the interesting thing from my point of view has been that since 2017, as you can see, the charts just absolutely gone through the roof. But the interesting thing is that 2021 was the first time that the average pricing from the industry actually got to the same level as it was back in 2015. So basically, there was 12 years of pricing going down, and then the insurance companies have all just knee-jerked and have gone chasing profitability at an astronomical rate. And I guess there's been lots of things that have happened in that sort of 12-year period. Lots of mergers on a global scene. So lots of businesses who, again, we see at the back end, and those reinsurance companies that we mentioned, there's a lot less of them today than there were. Using Lloyd's as an example, I think sort of 15 years ago, there was about 350 different Lloyd's syndicates. We're now down to sub 100 on that. So lots of consolidation, which has taken a lot of the sting out of the competition. Interest rates have changed, and just the relenting, I guess, expectation on public listed companies to start making some money. And we will start talking about data in a minute, because a lot of these businesses have started becoming very data driven. I do know we've got a couple of people on this call who have reasonable professional indemnity premiums. I will just touch on quickly just on the professional indemnity, but professional indemnity is probably worth a good sort of hour's discussion on its own. But professional indemnity is very much a two-speed market. A huge component of the professional indemnity market is made up out of the design and construct aspects. So builders, architects, engineers, and the like, and surveyors going and looking at premises to make sure that they have been adequately constructed. The premium on all of those aspects, probably over the last 3 years, have increased as much as probably 300%, and more if you're sort of in a business that's involved in the mining industry or anything else like that. Professional indemnity absolutely gone through the roof. And the other aspect that makes a huge component of the professional indemnity market is real estate agents' professional indemnity. It's had a big aspect, part of it. And again, just the drive of the professional indemnity or the real estate market in Australia has just driven premiums up, but also increased the premium pool. And again, insurers are starting to look into the future around what they think is going to happen in certain markets. And the claims history against real estate agents is going up, even though the premium pool is going up, and there's some big changes going on in that, which if anyone that's on the call that needs to have more of a chat about it one-on-one, happy to do that. But then the other side of the professional indemnity market, more and more, and accountants are under a lot of pressure, particularly if we're going into tougher financial times. People are suing their accountants and other professional advisors much more frequently than they were. But other businesses, and I'll use Tanya as an example, who's a marketing expert, those sort of clients need professional indemnity, and there is a fight for those sort of industries, with insurers really keen to get into those sort of industries and away from the design and construct aspects to try and, I guess, they've identified that sort of stuff makes money for them. So the bits that they think they can make money on, they're chasing, and the bits that have belted them around the ears a bit over the last couple of years, they're either just walking away from or escalating premiums at a really heavy rate. Yeah, that's, I guess, the interesting thing. Yes, the last 5 years, premiums have rocketed on average, but less so, I guess, if we look back to sort of that period of 2007, which until probably 2 years ago was the first time that insurers had consistently made money on underwriting. For the period between, they were making their money out of interest investment and other things, but they're being very tough going forward. Most of the people on this call, from what I could see, all of us have property as part of our portfolios. So I'll just draw some things out on that. Whether we're believers in climate change or not, the insurance companies are looking at their data, and they are saying very clearly that we are seeing an increase in our natural catastrophe claims. So flood, fire, hail, cyclones, all those sort of things. Over that period of time, the graph goes up. So they're factoring into their crystal ball gazing the fact that there's going to be more natural catastrophe claims. And we talked about the escalation of costs. The cost to repair something now are going up. So not only are they happening more often, they're costing more money. So that's an undeniable truth of the way the insurance companies are looking at it, whether they're right or wrong. That's the data that they're looking at, and they're sticking by it. And the recent events that most of us on this call would have seen from February, and I guess pretty much the couple of weeks after that, the catastrophe events of Southeast Queensland, New South Wales, has cost the insurance industry about $4 billion. And it is now the costliest flood event that Australia's ever seen. It's the 5th most costly insured event that Australia's ever seen, behind events like Cyclone Tracy and all the rest of it. Potentially, the size of this event has tipped the industry on its ear around how it manages claims and manages pricing. And most fascinatingly enough, whilst there's been this undertone for a period of time around putting pressure on governments and not having insurance companies just rebuild the same thing that was there before, the messaging that's now coming in around, I guess, resilience and sustainability of Australia is becoming a far more active conversation. And the government and the insurers are now saying, okay, well, how can we be smarter around this? Because it just does not make sense to keep rebuilding properties that are just going to get flooded or knocked down again. Maybe just a little bit of just one of the principles of insurance. The principle of insurance is ultimately that the many pay a little bit for the few that have their big claims. And if we keep paying for people who frequently keep having the same set of claims, the model starts to unravel because everyone is paying for the people that keep having claims. Then the people who are low risk end up paying too much, whilst the people who keep having the claims keep on getting the return on their investment, and the model starts to break down. But you then end up into these important sort of social issues around if insurance in North Queensland becomes unaffordable, how can you have people populating that area? And 127% increases in North Queensland on household insurance over the last few years is an obvious challenge. But again, these big events that have happened year on year are changing those conversations for the better. And I guess if we use somewhere like Roma as an example, it was effectively uninsurable sort of 5 years ago. Local government, state government, federal government have made investments in making those parts of the world safer for the communities, thus affordable, and it's now affordable. It is now insurable. But places like Lismore, etc., are probably on that same journey of we can't keep doing the same thing that we've been doing because it just stops making economic sense. So ultimately, what's driving the insurers' decisions? So again, the world we're in is all about data, and they're choosing to believe their data rather than what was traditionally the dark art of underwriting. Sort of a bit of a gut feel that this was a good account to be on. How do we do it? Data's driving all of their stuff, and I'll just go through this reasonably quickly because the important part is, well, what does it all mean? Insurers are becoming very focused on their product line. So we talked about professional indemnity, property insurance. They are trying to make sure each line is profitable on their own right. There is an expectation of increased natural catastrophes and the cost of them, pressure on material costs, pressure on supply chains, liability, cyber and professional indemnity claim settlements are continuing to escalate at an amazing rate. There is a community expectation that someone else will pay for, I guess, the things that happen to me. And insurers are crystal ball gazing. They're expecting tougher economic times. When things are tough, there's more slip and falls in shopping centres. There's more people who will look to insurance to get them out of a tough spot. And claims escalate. So that's, I guess, what they're looking at into the future. And I guess insurance companies also follow the same principles, but what is different this time? Again, I talked about they are far more data focused. They, I think at least I think all of the big public listed companies in Australia, Suncorp, IAG, the third one, but definitely those first two have now got basically accountants running them as CEOs. So they're very data focused. They are resisting being drawn into unprofitable competition. They're declining to put their capital up into industries or geographies that have cost them money. And again, lots of us would be seeing in the news, tattoo parlours are uninsurable, bizarre things like commercial laundries are pretty much uninsurable, some of the surveying industry, and those sort of things. Insurance companies have just said, look, we just keep putting the rates up, but we still keep losing on them. We can't keep doing those sectors anymore. They are also, the social responsibility aspect is becoming a key part of how insurers are choosing to engage. Their shareholders are expecting them to be involved in social responsibility decisions. Again, Adani keep raising the point that they are uninsurable, and that's getting in the way of them getting finance to progress what they're doing and slowing down what their position is, a major economic boost to Queensland. But insurers globally are basically saying that they don't want to be involved in the coal industry anymore. So interesting new pressures that we've just never seen coming through in respect of what insurance companies are prepared to do. But then just fascinatingly, the power of capitalism. Chubb in the US, which is where their head office is, as recently as this week, had a shareholder meeting where they said that they do expect Chubb to continue to be involved in insuring the coal industry, but have also put out a statement around the fact that they want to understand what Chubb are prepared to do to try and progress the world to net zero emissions. So you go, interesting. And then insurers in that chase for growth, because they still need to make money, because without making money, they can't be in business. They're looking towards new products, which are things like parametric insurance, which is basically if these three things happen, it triggers a policy which has got just some payout numbers around it. And then maybe as a bit of good news for those North Queenslanders, Shore Insurance is a new player in the North Queensland market, which the interesting thing about them is Liberty Insurance, which is their insurer, based out of America, are using North Queensland as an offset to their American wind exposure stuff, because their theory is they want to get smoother revenue. They don't think in any one year they're going to get hit in North Queensland at the same time as they get hit in North America for windstorm claims. And they're basically using that as a risk layoff to find ways of, I guess, making sure that they can keep their shareholders happy by having a smoother revenue stream. And then again, they're using that data to look for clients or products or industry segments that they think are well managed. It doesn't necessarily mean that they won't do high risk activities, but they want to have a high degree of certainty that the businesses are going to be well run and that they're truly doing what insurance companies want to do, which is paying for unforeseen events that are what insurance is really supposed to be about. So I guess cognizant of time, so what does this all mean to me? Ultimately, I guess from a client's point of view, insurance is very much about certainty. You buy insurance so that you're feeling safe and that your revenue and your assets are going to be protected. But if you put the underwriter's hats on, a lot of what we do with talking to our underwriters is trying to make them feel comfortable with the fact that the clients that we're bringing to the table for them are a safe bet. So part of that is, I guess, knowing the game that you're playing. So it's really important to ensure that you're partnering with your broker to ensure that they know everything about your business. And then I guess what all good brokers are good at is working through a way of ensuring that the insurers are comfortable with what you do, that they've accepted that risk before they sign up for it, and they know what they've got, and that remember, your broker is on your side, and we all need to have some adult conversations around different parts of your business, around if we don't think that the risk controls are going to be good enough for insurers, can we do something about that, or how do we position it? The other part is many of us have great things going on in our business that we just think of as being part of what we do every day. Things like quality assurance, what you do to protect your assets, and again, just working with your broker to make sure, and my apologies for the acronym, that we've got really good quality information around construction, occupation, protection information around things like fire extinguishers and all those sort of things, and the exposures around your properties are what insurance companies want to know that you're doing on that. And again, many of our medium to larger size property clients will have seen us getting far more pedantic about things like thermal testing and things on switchboards and things, because insurance claims data says that they get lots of fire claims from things like switchboards catching on fire. So again, just being able to demonstrate that you've got high quality maintenance programs around looking after your assets are the confidence things that insurers want to go, okay, so I'm going to cough up my money and put my capital behind X amounts of clients. How do I get more of the good ones that are less likely to have claims? We know some will, but let's get more good ones than bad ones, and we'll let someone else take the bad ones. And again, a good claims history is a bit of a guide to the future. Got to try and avoid being a maintenance claimant. We are seeing, I guess, an increase on claims of just rusty roofs and all of those sort of things that cost insurers money. Ultimately, insurers have contracted to pay claims for things that you and I couldn't have predicted, but they don't want to act as your maintenance program. Probably back to the earlier point, there is an expectation that we're going to look after our assets and our businesses in a professional manner. Some of our businesses, clients with big motor fleets and things, you are going to have crashes. You've got cars on the road, that happens. Things like considering what excess level is right for you. There's decisions to be made there around the commerciality of, am I better off just taking on some of those expenses myself, because an insurance company, if they know that they're going to pay $10,000 a year to you in insurance premiums every year, will then just stick a profit margin on top of it. We talked about the components of what makes up a premium. If they think they're up for 10 grand every year, they'll charge you 12 because they want to charge their profit premium on top of it. And then I guess the other interesting thing is that we do see, I guess, is we've got some highly entrepreneurial people, which is great. But I guess I encourage people to think about how you would treat certain circumstances if you could not buy insurance. To make that into a safe activity, if you couldn't buy insurance, what would I do to feel confident that this isn't going to financially hurt me at the end of the day? If you can take yourself through that process and go, okay, if I put these processes in and I do this and I do that, yes, I've got a high degree of confidence that this is going to work out well for me, then we can probably have the same conversation with an insurance company. But if you go through that process and you go, I still think that's going to end in tears, thus I wouldn't do it if I couldn't get insurance, maybe it's not such a great idea. That's, I guess, the key sort of guidances around how we would do those things. And I guess in conclusion, insurance is really complicated. To get a business policy put away, a business client's insurance needs put away, we're probably looking at a minimum of 3 up to 7 insurance policies for lots of our clients. It's really complicated. You need time to be able to navigate that, and you need to be sharing, I guess, what your business is doing into the future with your broker. We can help you with that. Insurers are really hard to deal with. They're hard work, but that's our job. We do it every day of the week, and we're pretty good at it. Claims are challenging. Again, that's our job. And ultimately, our purpose is to ensure that you never feel alone through that process. And I guess, I really encourage everyone just to make sure that they're sharing their business journeys with their brokers so that we can help to protect you into the future. So very happy to take questions either through, I guess, the chat or just in real life. And looks like Nerita's been able to sort the technology for me on that. So thank you, Nerita. I hope that was of some guidance for people. Yep.
Yeah, just unmute if you want to ask a question, or otherwise send in a little chat. I didn't see any chats come up. That's fine too. Or approach us directly and your broker directly if you've got any questions as well. Doesn't look like we've got any questions, which is fine. Our next webinar is actually about our people. Everybody in business, I think, is struggling the same way with trying to keep staff happy and on board. So the next one is actually getting the performance process right. We have Anna Chipperfield from Business Depot on that one on the 29th of June. So we'll send out invitations for that soon and hope to see you all then. Thank you.
Just have one quick question.
Oh, yeah.
Sorry. In talking about mitigating risks and things like that, possibly more to do with property, so your own house and everything like that, where's the best lead to get on that, on how to mitigate those things? Because I'm in far north Queensland, of course. It's, you know, we've just dealt with having to get Rivers to actually reduce the cost of our insurance from, you know, almost $5,000. And the quotes come through from Shaw at like $2,000. But I just noticed you were bringing up the whole idea of trying to mitigate the risks and everything like that. Is there anything you can recommend in houses, or best just to go back to the broker and talk to them?
Yeah, and and I think again, what Shaw have done is the answer is actually in the questions that Shaw are asking, which no doubt to get to the right result. Our North Queensland team have had to ask you questions around what is different to your house as opposed to the one down the road that hasn't had, that isn't as modern, that it doesn't meet sort of current cyclone standards. So in the first instance, one, it's asking the questions to just find out how good your building is in comparison to the one next door. And again, part of the game that Shaw are playing is they will still insure inferior buildings, but they will charge full rack rate for it plus a bit, and then a better building such as what I'm guessing yours must be to have that sort of a reduction. They're playing favourites. They'll give you a better rate, and they're using their data to say they expect to get a better result out of that. But then the questions that they ask to find that out is, when were you last? Did your wiring upgrades? When did you, have you replaced the roof? All those sort of things. The questions that they ask in that process are the things that are the answer to what do you need to work on to get a better result, which we have the same sort of conversations with our commercial property insurers around things like the thermal testing and things like that. Lots of our clients haven't done that because they haven't had the need to. And I'll tell the story. I remember going into a timber pub. We walked in with a thermal scanner, took a scan of the thing, and you could see this thing it was like a Christmas tree. And if we hadn't done the thermal scan on this thing, within the next couple of weeks, it was going to catch on fire. But we just happened to be there at the right time. And I think it cost $500 for the guys to come out and have someone sort of upgrade the various different fuses in their fuse box. So some of that stuff's just trying to be proactive, and again using some of that data to reduce the likelihood of a claim happening in a certain area. And again, for our business clients in that cyber insurance space, we talked about that graph that's gone like this on cyber insurance. Insurance companies didn't know what they were doing with that 5 years ago. They were making stuff up. They're now seeing the claims come through, and in the same way of protecting your assets for clients who are going to need cyber insurance going forward, we are asking all of our clients, what are you doing with backups? What are you doing with multi-factor authentication? Again, just practical things that if you didn't have insurance, what would you be doing? So I know that was a little bit of a loose answer, but I hope that helps with some guidance. Yep, cool.
Yeah, that's no problem. I'll just, like I was saying, I just wanted to make sure that the best place was that there wasn't a PDF I could read. It was just basically ask my broker. My broker is very good, so I'm
Wonderful.
not concerned about that. Tyrone is actually awesome. He's managed to save us thousands of dollars.
Yeah, no, you've got a bit of
Unreal.
a there with Tyrone, so that's great. Thank you.
Okay, thanks, guys.
All right, thank you,
Thanks,
guys.
Stephen. Okay, well, we might shut it down there. Thanks everybody for coming on, and we'll see you next time.